Good afternoon, everyone. Welcome to Vancity's 2023 Financial Literacy Month series of webinars. I'm Jeffrey Adams, a director in Vancity's Sustainable Wealth Management Division and Chief Investment Strategist with Vancity Investment Management. Today, I would like to acknowledge that we are joining you from the unceded territory of the Musqueam, Squamish, and Tsleil-Waututh First Nations, who have been custodians of this land for thousands of years. I would like to pay my respect to elders both past and present. We are hosting a free webinar every Thursday during November featuring topics of estate planning, retirement planning, and investments. Today's webinar is on income sources for retirement. This webinar will be recorded and shared with all registered attendees and will also be posted to our YouTube channel following the event. If you haven't already, please make sure you follow us on YouTube and our other various social media platforms to stay connected and get access to great content like this webinar. Finally, we encourage you to engage with us throughout this webinar, taking note of what's most valuable and what might be most helpful for you. The Q&A button allows you to submit questions at any time, and we'll be answering these questions following our presentations. With that, I'd like to introduce you to our speakers today. First, we'll hear from Paolo Trentolans, a wealth planner with Vancity Credit Union and Credential Asset Management. He holds a certified financial planner designation and is also a responsible investment specialist. Paolo has worked in financial services for over 17 years and puts in vast education and experience to work for members, creating tailored solutions that provide peace of mind that their financial goals are on firm ground. Next up, we have Annie Kwan, a wealth advisor with Vancity Credit Union and Credential Q-Trade Securities. She holds a certified financial planner designation and is also a responsible investment specialist. In her role as a wealth advisor, Annie leverages her extensive experience to provide members with personalized investment advice and solutions that align with their unique financial goals and objectives. With over 13 years of experience in delivering sound financial advice, she specializes in investment, tax, retirement, and estate planning, ensuring a comprehensive and tailored approach for each individual she serves. Following presentations from our resident experts, Barry Osmond, manager of Vancity Investment Management, will be moderating the Q&A and will also be providing closing remarks. I'd like to extend a heartfelt thank you to everyone for spending your valuable time with us today. Paolo, over to you.
Thank you, Jeffrey, for that introduction. We're going to get right into retirement income sources. And when it comes to retirement income sources, they essentially fall into three categories. The first one being government benefits, such things as the Canada Pension Plan and Old Age Security. The second category being employer-sponsored plans, more commonly pension plans, group retirement, registered retirement savings plans, and to a lesser extent, pooled registered pension plans and deferred profit sharing plans. And the third category that we can group in is registered retirement savings plans, locked-in registered retirement savings plans, locked-in retirement accounts, tax-free savings accounts, non-registered assets, either income from such things as rental from a suite in a home or maybe a rental property, perhaps business income, self-employment income, and potentially future downsizing of a home. Next slide, please. So we're going to start with the Canada Pension Plan. Canada Pension Plan was established in 1965 and is a self-supporting contributory plan. This means that all contributions are funded by participants and revenue is generated from the investments within. It is not funded through tax revenue. Contributions are based on employment earnings up to preset limits that change every year. Previously, there were concerns that CPP may be underfunded. Since then, changes were made, one of the biggest ones being that the Canada Pension Plan Investment Board was established. The board operates at arm's length with the government and is accountable to the public. So the government has no say in how the board operates. Similarly to how some of you may invest your RSPs, your registered retirement savings plans, or tax-free savings accounts, the board invests money in financial markets and reviews and revises the investments regularly. Contrary to some belief, the Canada Pension Plan is now on solid ground. Next slide, please. So the Canada Pension Plan offers three types of benefits. For the purposes of our presentation today, we are going to focus on the retirement benefit. So the first one being the maximum retirement pension at age 65, which is $13.06, 57 cents a month, or $15,679 a year as of 2023. For 2012, going back, the Canada Pension Plan also offers older workers, meaning 60 plus years who have started collecting their pension, a post-retirement benefit to supplement their normal Canada Pension Plan retirement pension. And also forthcoming in 2020-24 is a new component, which is the year's additional maximum pensionable earnings, or YAMPE for short. And that's designed for those who earn more than the current year's maximum pensionable earnings. The other benefits that you see listed on the screen there are survivor benefits. There's a couple available, one being a lump sum death benefit, and also a survivor pension for the surviving spouse or common law partner. A third one there you see as well is the disability benefit, designed for those who are not at retirement age but are off work due to a disability. Next slide, please. So your Canada Pension Plan benefits will be based on how much you contributed, what is also known as your recorded earnings, and for how long you contributed, which is your contributory period. Your contributory period is the time span that you would have been eligible to contribute to the Canada Pension Plan. Usually starts at age 18 and ending the earliest of when you start your retirement pension, turn age 70, or pass away. Your Canada Pension Plan statement of contributions gives you this information and will tell you how much your benefit will be at age 60, 65, and 70. For us planners, it is a fantastic tool to use when we're helping our members plan for their retirement. You should receive a statement of contributions periodically, but you can also request one by phone or online, and that's the best way to get one quickly and one that is up to date. So when it comes to determining your benefits, there are a couple of dropout provisions in place that will keep your benefits as high as possible. If you have years of lower earning, 17% will be excluded from the calculation. So for example, if you're retiring at 65, which is a 47-year contributory period, it means 8 years will automatically be excluded. If retiring at 60, it's a shorter contributory period of 42 years, approximately 7.1 years is excluded. Also for years where you were out of the workforce because you were the primary caregiver of a child under 7 and had low or no income, those years can be dropped as well. Noted this provision is applied before the 17% dropout provision, so it is beneficial to those that have been out of the workforce raising children. Canada Pension Plan benefits are fully taxable. To receive the benefit, it is not automatic. You must apply for it in writing. Next slide, please. So when you decide that it's time to take your Canada Pension Plan, you have choices when to start it, beginning as early as 60 years old. So if you decide to collect it at 60 years old and you're still working, there's no longer a provision that you have to stop working, but you must contribute to a new benefit, the post-retirement benefit. It's a mandatory contribution that you must make. The post-retirement benefit is automatically added to next year's pension. So your pension goes up from these contributions. Note that if you apply at 60 years old and any month before 65, it is reduced 0.6% per month before the age of 65. So if you decide to retire, if you decide to take your Canada Pension Plan at age 60, if you add that all up, that's a 36% drop in your pension. Then had you wait until age 65. 65 is considered your normal pension age, and that's where you get your personal maximum. If you continue to work past 65 and you decide to take your pension, you can have the option to continue contributing to the post-retirement benefit. Note that there is a benefit to delaying taking your CPP past 65, where it starts to increase 0.7% per month past that age, up to a maximum of 42% at age 70. So to give you an example using a simple figure, if we took $1,000 as your normal CPP at age 65, should you take it at age 60, the amount would be $640. If you were to take it at age 70, it would be $1,420. So the difference between 60 and 65 is $780 a month. Whether that makes sense for you And there's no silver bullet in answer to this question. It all depends on working with your advisor as to when you're going to take it at 60, 65, 70, or anywhere in between. Next slide, please. So just a little recap on some of the recent changes to the Canada Pension Plan. Some of them I've already mentioned. So this is a big one here, the removal of the work cessation test. So that's important. That came in 2012. And what that means is you don't have to stop working to collect your Canada Pension Plan. But again, as I mentioned earlier, if you continue working, you must make mandatory contributions to the post-retirement benefit before 65. And what this does is increases your pension in the following year. Working Canada Pension Plan recipients continue to contribute to CPP, the post-retirement benefit, pardon me. Increasing the number of low earning dropout years is 17%. So again, that's 8 years of retiring at 65, 7.1 years at age 60. Increasing the number of, increasing the changes to pension adjustments for early Canada Pension Plan take-up. So if you take it earlier, it's 0.6% per month reduced. If you're taking it after, it's 0.7% increase. And there was an increase in contribution rates that began in 2019, and they're maxing out in this year. And what it is now is 5.95% of employment earnings. So that's for amounts between $3,500, which is excluded from pensions, up to a maximum of the year's maximum pensionable earnings, which is $66,600. So for employees, this means contributions of $3,755 approximately, and for self-employed, we have to make the full contribution of both the employer and the employee. It's $7,509 approximately. And then again, beginning in 2024, additional contributions beyond the year's maximum pensionable earnings would be the year's additional maximum pensionable earnings, or YMPR. So that rate is 4% for the employee and 8% for the self-employed. What this means in 2024, that if you're earning higher than what we traditionally know as the year's maximum pensionable earnings, an additional $188 in CPP contributions, and then for 2025, an additional $398. So for resources for checking, next slide, please. So resources for CPP information, you see the contact number on your screen. That's if you want to have that information sent to you. And if you also want to do it self-serve online, you can do it at the website there. Next, I'm going to pass it on to Annie, who's going to talk to you about old age security.
Thank you, Paolo, for the wonderful information about the Canada Pension Plan. Hi, everyone. My name is Annie, and I'm going to continue with the retirement income sources. Now, let's dive into the old age security. Old age security is essentially a government pension set up for citizens at the age of 65 and up, providing them with some financial backup. Consider old age security as a key income source in Canada's retirement program. This program is currently being managed by Service Canada, part of the federal government. The initiative has been around since 1952, and the interesting part is that, unlike CPP, this is not your usual contribution-based program. Instead, it is fully fueled by the general tax revenues. I've actually had some of my members ask me if the program is not self-funded, will it disappear? At this moment, there is no worry about the future availability of this benefit. As income levels are projected to increase, we also anticipate tax revenues are going to rise as well. To tap in a little bit about the old age security benefit, one must be at least 65 years old. If you are automatically enrolled, do expect a notification letter at your mailbox the month following your 64th birthday. If you're not automatically enrolled, the alternative is a straightforward written application sent to the Government of Canada. And for those who embrace the digital age, there is a simple online application form that you can fill out easily. Next, we'll talk about recent changes to the OAS. Before that, let's talk a little bit about how to qualify OAS. To qualify for the old age security, you must be a Canadian citizen or a legal resident and lived in Canada for a minimum of number of years. In terms of the amount, individuals aged between 65 to 74 currently can anticipate a maximum monthly payout of $687.50, while those aged 75 and above will see a slight increase of $756.32. So how do we get full benefits from OAS? For a full pension, you must have lived in Canada for at least 40 years after the age of 18. Any absences from Canada in the last 10 years can actually be made up with additional time in the past. To qualify for partial benefit, you must live in Canada for at least 10 years after the age of 18. The best way to think of this is think of the old age security like a large pie divided by 40 equal parts. A full pension means you qualify for all 40 portions, and if you lived here for 10 years, then you will only qualify for a quarter of the full pension. Lastly, old age security pensions are taxable in Canada. The government withholds taxes at source, and the amount withheld depends on your total income. You need to remember to include your old age security income while filing your annual tax return, and your actual tax liability will be calculated based on your overall income at the applicable tax rates. Keep in mind that tax laws always change, so consult with a tax professional or check the latest information from the Canada Revenue Agency website. And now we'll talk about recent changes to the OAS. Next slide, please. So there are two changes to the old age security. Changes number one, starting in July 2013, you now have the opportunity to defer your old age security for up to 5 years, allowing you to start receiving between the ages of 66 and 70 years old. Now, it is worth noting that should you decide to postpone receiving your old age security pension in Canada after hitting the age of 65, your benefit actually goes up by 0.6% for each month that you defer. If you defer your old age security pension, your guaranteed income supplement payment, if applicable, will also be deferred. It is important to note that unlike your old age security, the guaranteed income supplement does not experience an increase due to this deferral. As a result, this option may not be as appealing to seniors with low income. I'll talk a little bit about the GIS. It is essentially a Canadian program designed to provide additional financial assistance to seniors with low income as part of the old age security system. We'll dive into the specifics of the guaranteed income supplement a little bit later. Now, in the unfortunate event, if one passes away before collecting your OAS, there will be no survivor benefit for your spouse or children, unlike the Canada Pension Plan, which you will continue to receive the benefit. The deferral option may also be more favorable among individuals with significantly higher income who faces the old age security clawback. They may want to defer their old age security until later when they may have stopped working or reorganized their finances to reduce taxable income. For those eager to explore further detailed information on voluntary deferral can be found on the Service Canada website under the title Old Age Security, How Much Could You Receive? We can share that link in the next couple of slides later. Change number 2. Now you may ask us, how does a senior who wants to defer their old age security notify Service of Canada if they no longer need to apply to start the old age security? The answer is pretty simple. You access My Service Canada account and follow the directions to defer old age security pension or send a letter to the Service Canada. Next slide, please. This is the information we have put the toll-free number and the website that you could utilize to contact the government. Next slide. Thank you. Now let's talk a little bit about some other government sources. First, there is the Guaranteed Income Supplement, which I have previously mentioned. It is essentially a part of Canada's Old Age Security Program, and it provides additional financial support to low-income seniors. It is available to those receiving the Old Age Security pension with eligibility based on income and marital status. Now, the Guaranteed Income Supplement may vary, with lower income seniors receiving higher benefits. Seniors need to apply for the Old Age Security to qualify for Guaranteed Income Supplement, which is adjusted quarterly based on the cost of living. Remember, this is critical. You must be receiving the Old Age Security to qualify for Guaranteed Income Supplement, and it's non-taxable but subject to income testing. Next up is the Seniors Supplement in British Columbia. Again, this is an offer to financial support to the low-income seniors. To qualify for the Seniors Supplement, you generally need to be a resident. You need to be age 65 or older, and you need to be eligible for the Old Age Security and the Guaranteed Income Supplement and have low income. You can apply this through the government website. In summary, these programs can provide critical financial support for seniors, contributing to a more secure retirement. If you or someone you know meets the criteria, it's worth exploring these incomes for added peace of mind in the golden years. Next slide, please. Now, the second category is the employer-sponsored retirement plans. There are two types of plans that I will go over in detail. First one is the Defined Benefit Registered Pension Plan. This plan ensures a predetermined pension payout based on factors like your salary or years of services. Employers manage it to secure guaranteed retirement income. Typically, this benefit kicks in around the age of 65, with the options to early or delayed retirement. However, early retirement may result in reduced benefits due to specific provisions. In the defined benefit plans, the normal form ensures payment for at least 5 years, even if someone passes away early. The joint and last survivor option continue payments for the surviving spouse, but might reduce monthly payments while both participants are alive. You may see these common terms, including bridging payments. This really means a temporary supplement before your government benefits start. You may also see the common term called indexation, and this is the adjusting pension due to the cost of living. Now, employers might also offer other plans like the defined contribution plan, which I'll go over it in a little while. There's the group RSP, the pooled registered pension plan, and the deferred profit sharing plan, and retiring allowances for long-term services. Knowing these details is important, so make sure you talk to your employer to get the info that fits your situation in the retirement plans they offer. Next, I'll talk a little bit about the defined contribution plan. The defined contribution plan is a retirement saving arrangement where both employees and employers contribute to an individual's account. The future benefit is not predetermined, unlike the defined benefit plan, and it depends on your contribution, the investment return, and the actual market performance. It's worth noting that there is no predetermined monthly pension amount, and upon reaching the age of 65, individuals can start withdrawing funds from their defined contribution plan without restrictions. Withdrawals are subject to income tax, and the amount again depends on the individual's tax bracket. And I will pass the presentation to Paolo. Thank you.
Thank you, Annie. We're now going to get into our final source of retirement income, and that's going to be personal savings or income. Things that we touched on at the beginning: registered retirement savings plans, tax-free savings accounts, non-registered assets, and other personal sources. Next slide, please. So a registered retirement savings plan is probably the most common one that I think our members are familiar with. And it's a retirement vehicle where you can accumulate savings on a tax-deferred basis and receive a tax deduction upfront as an incentive for doing it. So tax deferred simply means that while the funds are in your registered retirement savings plan and invested and generating returns, those returns are not taxable. What is taxable is your withdrawals when you eventually withdraw from the registered retirement savings plan. An RRSP, registered retirement savings plan, may be converted to a registered retirement income fund or a registered annuity at any time, but must be done by the end of the year that you turn 71. A registered retirement income fund or a registered annuity provided income stream at retirement. So when it comes to the registered retirement income fund, minimum amounts must be withdrawn each year from the RIF and is fully taxable as income. Registered retirement savings plan funds can also be used to buy a life annuity. Payments for the annuity would also be fully taxed. Next slide, please. So for locked-in registered retirement savings plans and locked-in retirement accounts, your option at conversion is a locked-in fund, a registered locked-in fund, and registered annuities. Generally speaking, monies from the locked-in RSP that go into a locked-in fund originate from an employer-sponsored pension plan that's usually received after you've ended your employment. Those funds are regulated by federal and provincial legislation, which means that there's a minimum amount that you can take out on a monthly basis, but there's also the option to take out a maximum payment. The maximum payments are generally designed to finish by the time you are 90 years old. And whether you choose to take the minimum or maximum will really depend on your personal circumstances, things like life expectancy and all other sources of retirement income. Next slide, please. Tax-free savings account, which can be used for a multitude of things, are also a great source to be used for your retirement income. Note that contributions to a tax-free savings account are not tax deductible, but the withdrawals are tax-free, which means they don't affect any federal income tested benefits. So this is a huge advantage to retirees. One thing to note is that a TFSA, although it doesn't allow you to deduct, it is a great tool to use for retirement because you can take those lump sums out and not have to worry about taxing the taxes that will be applicable on there. Next slide, please. So other things as well can come from your own non-registered savings and investments. So if you've managed to max out your registered retirement savings plan, if you manage to max out your tax-free savings account, well, that's where you can look to other options and continue to invest for your retirement. Next slide, please. So some of the other personal sources could include part-time employment. I have met a lot of my members that have chosen to return to work. Sometimes it's out of necessity, sometimes it's just out of keeping busy, but that can contribute to your sources of retirement income. Business income, this is a little less common unless it's a family business where you still are earning a salary from it. Downsizing a home and using those proceeds to invest to generate a return. Rental income, which could come from a basement or an additional property. And at some point, this may be considered to be sold, which could also be used as more sources of retirement income. Now I'm going to pass on the next slide to Annie, who's going to give you a summary.
Thank you, Paolo. So in summary, understanding where your retirement income comes from is key. There are different sources at different tax implications. For instance, if you receive dividends and capital gains, you get a tax break in Canada, making them tax efficient. Pensions and retirement income funds, especially for those who are over 65, can offer tax advantages with benefits like the pension income credit and income splitting, which will reduce your overall taxes. You want to make sure that you're strategically spending your income across the sources that can optimize your overall tax efficiency. For personalized advice, it's always good to have a chat with a tax professional or your financial advisor. And lastly, don't forget about the tax-free savings account. The tax-free savings account is a non-taxable option you might want to consider for your retirement savings. Next slide, please. Finally, please be aware that as we aim to provide you the most accurate information, but keep in mind that there are always changes in laws or regulations that may impact the validity of these information, and that we would advise you to consult a professional due to each and individual specific circumstances. I really appreciate the chance to share this valuable information with you. At Vancity, we have a team of skilled wealth professionals that are ready to design a personalized Vancity advice plan that are aligned with your unique financial goals. Now we're ready to answer any questions you may have.
Hi, everyone. My name is Barry, and I'll be moderating the questions here. So thank you to both Paolo and Annie for providing this information here. And just a quick reminder to our audience members, please feel free to post your questions in the Q&A section of the presentation here. And we'll spend the next few minutes going through the questions. We have a good number of questions to start with. So I will start with the first question to Paolo. Paolo, this question is around RRSPs, and the question comes to us from one of our audience members. Should RRSPs be used first so that once one can get more benefit from the government, or is this a myth?
Thank you for the question. Thank you, Barry. So when it comes to whether to use your RSPs before other sources to get more benefit from the government, it's really going to depend on all your sources of retirement income. So there's unfortunately not a one size fits all. So what I think this is really pertaining to is the supplement that's available to old age security, and that's the guaranteed income supplement. So if your income is low enough as an individual, or they also consider if you have a spouse or common law partner, there's the potential to earn that guaranteed income supplement. So the theory is that if you take your RSPs first, which are taxable on that, and factored into your eligibility for guaranteed income supplement, then should you withdraw it sooner? So I do have a situation where I was working with a member where it actually did make sense to draw it down sooner, but he was in a very unique situation where it worked. For those that have higher amounts of registered retirement savings plan, you have other pensions that are significant from your employer, it's likely not the case to draw it down sooner. So unfortunately, it's not a one size fits all answer. It is a case by case. And generally speaking, working with you, we can figure out what's going to be the most appropriate solution as whether to do that or not.
Thanks for the answer, Paolo. And yeah, I think you touched upon a really good point here that, the information that we're sharing here today is quite general in nature, where, each person's circumstances and financial needs are going to be unique to their own personal situation. So please, continue to post your questions, but I highly recommend, as we mentioned earlier in the presentation, that it's really important to seek professional advice when it comes to retirement planning and having the right information that you need to have in place in order to make informed decisions. With that, I have another question that I'm going to pose to Annie. The question is about the guaranteed income supplement. What are some of the things that I need to be cautious about when it comes to collecting guaranteed income supplement?
Yeah, thank you, Barry. So as I was mentioning in the previous slides, the guaranteed income supplement benefit is income tested, meaning that the amount you receive is based on your annual income. If your income is below a certain threshold, you may qualify for a higher guaranteed income supplement payment. However, as your income increases, the guaranteed income supplement benefit will gradually decrease and eventually phases out. So you really need to be mindful about the source of income that you will be receiving. And that may include any rental income, any investment income, essentially any income that you will declare on your taxes will affect how much you receive in your guaranteed income supplement. So it is critical that you understand this before you receive your guarantee and continue to receive your guaranteed income supplement.
Great. Thank you for that answer, Annie. The next question I will be turning over to Paulo. As a dual U.S. Canadian citizen, I've learned TFSA's or tax-free savings account is not a good option for me. Are there U.S. tax implications with an RRSP?
Thank you for the question. So when it comes to being a U.S. citizen and what are the implications for an RRSP, so the U.S. government and the Canadian government do have a tax treaty where the IRS does recognize registered retirement savings plans. So if you are a U.S. citizen or a U.S. person for tax purposes, I should say, living in Canada, you can generate RRSP room, you can make contributions to your RRSP, you can deduct it. It will grow tax deferred. So you get that benefit. And then when you withdraw it, it is considered income for tax purposes. So you will have to file your taxes both in Canada and the US, and depending on the outcome of that will determine what the amount of tax you'll pay and to whom. And for that, you'll need a cross-border tax specialist to help you with that. So hopefully that answered the question.
Yeah, thanks for the answer, Paulo. That was a really good recommendation as consultant with a tax expert and a cross-border expert. That's where you're going to get the best advice with respect to investments, if you're a dual citizen or if you are a resident of another country. The next question I'm going to be sending to Annie's way. I'm a teacher with a pension. What are some of the things that I should consider prior to retiring? Should I delay my CPP and OAS?
Thank you for that question. As a teacher with pension, there are several factors when approaching retirement. I can provide you some general guidance, but remember, it's, again, important to know that individual circumstances can vary, and we will also always advise you to consult with your accountant. But essentially, it depends on your existing pension options. You have to understand the details of your pension plan. You have to understand your financial goal. You have to know your government benefits, how much you will be receiving for your CPP and OAS, old age security, and you have to understand the tax implication of your pension income, government benefits, and any other source of income at retirement. So by doing this, we will have strategies to minimize your taxes, such as income splitting with a spouse. You also have to review potentially your healthcare coverage and understand your debt management. So again, it is a full picture to plan before we really decide to tell you if you should delay your collection of your Canada Pension Plan and old age security.
Thank you for the answer, Annie. Next question to Paulo. What happens to an RRSP if someone retires abroad?
Thank you for the question. So if you retire abroad, you can actually still retain your RRSP. There is no requirement to collapse it. If it's also been converted to registered retirement income fund, you can retain it. There is no requirement to collapse it. I will say, though, that if you are working with an advisor and you do have market-based investments, such as a mutual fund, it does limit the way we can assist you because we're under securities regulation. And so there's very little that we can do in terms of advice, in terms of the actual investments while it's in there. But in terms of retaining it as an RSP or a registered retirement income fund, it can absolutely stay that way. Noted, though, that when you are withdrawing from a registered retirement income fund, there's different payment structures we can do, which are what's known as like the minimum and maximum payment, which I mentioned in the presentation. If you're taking a minimum payment, there's no requirement to withhold taxes, but if you're retiring abroad, there's a minimum requirement of 25% withholding taxes, regardless of your tax bracket, unless there's a treaty with that country that changes that. So yeah, in short, you can keep it, but there are some tax implications to be aware of on the withdrawals.
Thanks, Paulo. Next question to Annie. Could you please elaborate a little more about pension tax credits?
Sure. The pension income credit is the pension income amount in Canada allows any taxpayers to claim a federal non-refundable tax credit on up to $2,000 of eligible pension income. The federal tax credit rate is at 15%, so this will result in a maximum federal tax savings of $300. You take 2,000 times 15% gets you to $300. This non-refundable tax credit can help reduce federal income tax liability, but it does not generate a refund. Eligible income sources include your registered pension plans, your RRSP, and your annuities. It is important to check the current guidelines from the Canada Revenue Agency, or again, consult with a tax professional for accurate and up-to-date information.
Thanks, Annie. Okay, Paulo, next question is coming your way. Is there a maximum amount that you can deposit to or transfer to your tax-free savings account from your RRSPs?
So when it comes to making contributions to your tax-free savings account, if you choose to use your RSP, it would be considered a withdrawal. So there's no tax-free rollover provision, if that's what the question is asking, where there's a certain amount that you can move to your RSP, to your TFSA, without incurring it as income for the year and being taxable. So if you were to decide to move some of your RSP to your TFSA, it would be considered a withdrawal, and you would do that after the taxes have been taken away. In terms of the maximum amounts that you can deposit to your TFSA, each year going back to 2009, if you were 18 years of age or older at the time and a resident of Canada and you had a valid social insurance number, that's when we got our first bit of room for that plan. And if you hadn't contributed and you were everything held true up till today, the maximum now would be $88,000. So at the end of the day, to confirm what your personal limit is, there's a couple ways you can do it. You can call Revenue Canada, and there's an automated service where you need your most recent tax return and some information to get the automated amount of what you can contribute to your tax-free savings account. The other way, which I think is a little bit quicker and faster, is signing up online with My Account for Individuals through Canada Revenue Agency. And that allows you to see both your tax-free savings account limit and your registered retirement savings plan limit.
Excellent answer there, Paulo. Thank you for that. And I think the next question is probably on a lot of our minds here with the rising cost of living and inflation. The question from our audience is about the indexation to inflation for old age security benefits. Annie, are you able to shed some light on that, please?
Yes, definitely. The old age security benefits in Canada are indeed indexed to inflation. The indexing is done on a quarterly basis using the Consumer Price Index. This means that the old age security benefits are adjusted to keep pace with our rising cost of living, helping to ensure that the purchasing power of these benefits is maintained over time.
Great, thank you. It's good to know that our pensions and benefits are indexed to inflation, and this is really good, especially with the rising cost of living. So thank you for that answer, Annie. Paulo, this question is quite interesting here, and we have a situation where someone has asked, I'd like to spend, the winter months in a warmer place abroad. Can I still receive my government benefits such as CPP and OAS? And is there a limit to how long I can stay abroad?
Thank you for the question, Barry. I'll start with Canada Pension Plan. Canada Pension Plan is a contributory plan, which means that you make contributions to it, so you're entitled to that benefit. So if you decide to go live abroad, you can fully collect your Canada Pension Plan outside of Canada. There's no requirement to return for 6 months of the year or anything like that. When it comes to old age security, You have to have been a 20-year resident of Canada in order to collect your old age security pension outside of Canada. So, if you've come at 45 years old and you're planning on working until 65 and you hit that 20-year mark, well, that's kind of the sweet spot. If you're going to be returning to your country to retire, then you'll be able to collect it outside of the country. And there's no requirement to return. So as long as you hit that 20-year mark on the old age security, you're okay.
That's great. Thanks for that, Paulo. And again, a friendly reminder, when you're dealing with cross-border tax situations and implications, we highly recommend that you consult with a tax expert and a cross-border expert. Rules and laws and taxation regulations change on a regular basis. So, there is a lot of information that you hear here that will get updated, for 2024 and for the year after. So it's really important to consult with a professional, speak to one of us here at Vancity. We're more than happy to provide you with the information that's available to us. And then beyond that, we highly recommend that you continue to consult with tax experts and cross-border experts to get the right information that's specific to your personal situation. With that, I have another question that I'm going to be turning over to Annie. Annie, this question is about old age security benefits. The question comes to us: I plan to sell my rental property to supplement my retirement income. How does the sale of this property impact my OAS benefit if I decide to sell the year prior to receiving OAS?
That's a great question, Barry. So if you were to sell your investment property, all the capital gains will be considered as part of the income for this year. So if you sell the property in the year prior to you applying for your old age security, your old age security will become income tested. And if your income exceeds a certain threshold, in 2023, this income threshold is currently around $87,000. You may be subject to the old age security recovery tax. Obviously, again, each individual situation is different, but there are ways to reduce your income if you have enough RSP contribution room. You can make an RSP contribution to reduce your taxable income. You can think of potentially delaying your old age security for a year. And if you have existing investments, you can also look at harvesting some of the capital losses if it's applicable to offset your capital gains. So there are these certain ways that you can reduce your income to avoid a old age security clawback.
Excellent. And thank you for the answer there, Annie. And you mentioned RRSPs, so we actually have a very timely question as well about RRSPs. And the question is, should you keep contributing to your RRSPs in retirement? And I'm going to flip this over to Paulo to help us with this answer.
Thank you for the question. So should you keep contributing to your RSP in retirement? So what's going to be important is to recognize if there's going to be an income drop down the road, because the purpose of contributing to a registered retirement savings plan is that you're doing it in a higher income year. So maybe you're still working part-time and income is higher, and you don't expect that part-time income to continue, and it's going to drop you to a lower income down the road, essentially moving you out of a higher tax bracket to a lower tax bracket. So that could be potentially a situation where it still makes sense to make RRSP contributions. But then again, there's always the purpose of the savings that's important. So maybe you're working part-time because you're saving for a child's wedding or a renovation on your home or a big trip, or you plan on making a significant withdrawal from those savings down the road. That's a situation where you might potentially choose to use a different savings vehicle, like a tax-free savings account, because that withdrawal is going to be tax-free. So it's hard to really say on that question what's going to be better, one or the other. As again, advice like this is tailored, so it would be like a case-by-case basis. But those are two examples to consider.
Thanks for that answer, Paolo. I like this question, and I'm going to ask Annie if she can help us here. So, how do I discuss with Vancity, a Vancity professional, if an RSP is a good option for me or not?
Yeah, so at RSP, if it's a good option or not, again, it goes on a bigger picture. We have to take a look at what your retirement desired income is. We have to look at your overall financial picture. And most importantly, we have to understand your current annual income to see if making an RSP contribution to reduce your taxable income is a good option for you. So we would invite you to come in and talk to one of us to make sure that this is a good option for you.
Thank you for the answer, Annie. And we definitely will be posting our contact information as we get closer to wrapping up here. But as Annie mentioned, you're more than welcome to reach out to Vancity, set up an appointment to meet with one of our professionals. We're happy to actually do a financial plan for you, tailored to your needs, so we can walk you through it. We have a very extensive suite of options that are available to us to help you, navigate the different retirement options and the different savings options here at Vancity. The next question, maybe I'm just gonna pose a general question here to Paolo. If we could maybe at a high level kind of describe what can we do when someone wants to convert their RRSPs to an RRIF.
Yeah, thank you, Barry. When it comes to converting your registered retirement savings plan to a registered retirement income fund, the way I work with my members is determining the need of income and for how long. So at the minimum, when you convert your RSP to a RIF, there's a minimum payment option. And the minimum payment option up until age 70 is based on a percentage, or your age, pardon me, in an equation. So essentially at the end of the day, it's a percentage. So a minimum payment just means whatever your balance is at the beginning of the year, that minimum percentage has to come out for the full year. So for an example, if you're age 70 to start the year, so you might be turning 71 to start the year. If you're 70 and you have $100,000 in your account, well, the minimum payment is 5%. You have to take out a minimum of $5,000 that year. Whether you choose to take it out as a lump sum or monthly, that's your decision and in discussion with your advisor. But essentially, that's the percentage that has to come out. In the following year, it's a higher percentage. At age 71, it's 5.28%, and whatever the balance is there. So the balance of the following year will be dependent on how your investments in your registered retirement income fund performed. That's the most basic option and really designed to provide you with lifelong income. Another option is choosing a payment that's set. So in the $100,000 example, let's assume you decide to take $10,000 a year as your payment. Well, without considering interest, it's going to last 10 years. And if you're 70 years old, that's only going to take you until 80. For some members, that's the period of time that they're maybe still enjoying travel and extracurricular activities. And so they want to use that RSP, that RIF for that purpose. The final one is choosing a specified period of time that you want it drawn down over. So if you're 70 years old and you let us know, well, I would like this to last until I'm 90. Well, that's 20 years. Without considering interest, that's going to be, again, $5,000 a year. So those are the options we picked from. And when it comes to taxes on there, again, it is taxable as income. On a minimum payment, you're not required to withhold tax, but myself and Annie as planners, we assess the overall income and help you determine what's an appropriate amount to withhold. When it comes to the set amount that's higher than the minimum, there are some mandatory withholding taxes that need to be applied. So hopefully that's answered the question, Barry.
Thank you for that, Paolo. And I think we have time for one more question, and it's quite timely as we're approaching the end of our presentation here. The question is, can I speak to someone in person or over the phone over my personal situation? Annie, maybe I can pass this on to you.
Definitely, we have wealth professionals available at every single Vancity branch. We also have phone phone channels, and sometimes for some of my members who are living a little bit further than where my physical branches is, we do virtual meetings using Zoom appointments as well. So there's various channels for us to contact you based on wherever you are. So we have availabilities anywhere for you.
All right, thank you, Annie. And I think this will certainly bring us to the almost the conclusion of this presentation today. I'd like to thank Paolo and Annie and Jeffrey for being here with us today and providing this informative session to our audience. I'd like to also thank all of our audience members for signing up and joining us in today's session, and also for the very engaging questions. Just a quick reminder that this presentation will be recorded, and those who have registered to the webinar will receive a link to the recording shortly after today's presentation. And it will also be uploaded to our Vancity channel on YouTube. Overall, your questions are really valuable and your participation is really important to us. However, each person's circumstances are quite unique to themselves. So we highly recommend that you take this information as a general guideline, and please contact a professional to seek professional advice. And also, if you're thinking about something that's a little more complex, we highly recommend that you also consult with a tax or a cross-border expert. With that in mind, there will be a link to a short survey through our QR code that we would really appreciate if you could take a moment or two to share your opinion about the webinar and about future topics that we're going to be putting together. And also, we invite you to join us next Thursday for the next webinar in the series. As Jeffrey mentioned earlier, we have a series throughout the month of November where every Thursday we have a different topic. And next week's presentation is about deciphering current market conditions. And with that being said, I'd like to thank you again for your participation and wish you all a great day.